In this chapter, we'll study about government intervention in the product markets through both price controls and taxation. The first tool that governments can use to influence the market outcome is price ceiling. Price ceiling imposes the maximum amount to which a price of a good or a service can rise. In panel A, the equilibrium price is 3, and at $3 the equilibrium quantity is 100 units. But suppose government imposes a price ceiling of 4. Now this price ceiling is already above the equilibrium price, and thus it will not really influence the market outcome. Here the price will still be $3 and the quantity in equilibrium will be 100. However, in panel B, suppose government influenced by a study which talks about the health benefits of ice cream considers ice cream to be good and thus wants to keep its price low and puts a price ceiling of $2 in the market for ice creams. Now this $2 is below the equilibrium price, and this is called a binding price ceiling. In a free market economy, if the price was $2, there would be a shortage. The result of a shortage would imply that the prices will start rising and the equilibrium will be restored to $3. But here, government is preventing the prices from going beyond 2. At $2, we have 125 units of ice cream demanded and 75 units of ice cream supplied, resulting in a shortage of 50 units of ice cream. Now this price ceiling has sometimes been used by government and is still used especially in the market for rents, so for apartments. But during the Great Depression, government kept prices of most of the commodities fairly low during the war times. Because of prices being low, there would be a shortage in the market for basic services and basic commodities. The way government managed this was by issuing a ration card. So each household would get a ration card, and based on that ration card, they would buy the things allocated to them. The other form of government intervention is a price floor. Now price floor is usually with the intention of protecting the suppliers. Price floor is the lowest price at which the price of a commodity can fall. In panel A, the equilibrium price for ice creams is $3 and government has set a price floor of 2. So price of ice creams cannot fall before 2. However, in the free market, the price being determined is higher than the price floor. That is $3. So in this case, the price floor is not really influencing the market outcome, and we call it non-binding. In panel B, however, suppose government imposes a restriction that price of ice creams cannot fall below $4. The equilibrium price of ice creams was 3, and now we have a binding or effective price floor. As a result of this binding price floor, we will have more sellers willing to supply ice cream. The quantity supplied of ice cream will go up to 120, and we'll have fewer buyers willing to buy ice cream. The quantity demanded falls to 80, resulting in a surplus of 40 units. Now, if you recall from chapter 1, one of the principles of economics was that markets are usually a good way to organize economic activity. How is economic activity organized? Well, the economic activity is organized through the signal given by the price mechanism. Prices signify scarcity, they signify shortage, and they're just to eliminate both these issues. If prices are prevented from adjusting, we will have a misallocation of resources. and we will have a disequilibrium in the market. In this sense, it is said that often prices work best, and markets should be left best to their own, because they will adjust and clear through a movement of prices. As we see in the example of rent control, the intention of rent control would be to keep the pricing of the housing market fairly low. However, because of rent control, we may have poor quality apartments being provided, less apartments being provided, and this may adversely affect the poor. However, it is not true that price controls are always bad. Consider the market for tobacco. Government has a fairly generous price floor in the market for tobacco, and this price floor is binding. So government does not let the price of tobacco fall to the equilibrium level. They keep it much higher than the equilibrium level. The way the price floor works is that government will pay the farmers or will buy crop from the farmers and keep the price of tobacco high. As the price of tobacco is kept high, tobacco is an input in the production of cigarettes. The cost of cigarettes will be kept high, and thus discouraging its widespread consumption. So sometimes government policy can result in a greater or a more desirable outcome than what the free markets may result in. The second tool which governments can use to influence market outcomes are the use of taxes. Now, from a public policy standpoint, taxes are essential because government needs to raise revenue to provide for several public and social services. Government is not an enterprise. It's not a corporation. It does not have its earnings by selling a product or a service. Government have to raise revenue to finance their expenditure through taxes. Tax can also have a second impact. Sometimes taxes can be used to alter the behavior of buyers or sellers in a particular market. Government can either impose a tax on buyers or they can impose a tax on sellers. The tax can be a percentage amount of the price of a good, or it can be a fixed dollar amount per unit of the good being consumed. One can easily be converted into the other. To keep things simple, in this course or in this chapter we'll analyze tax in terms of a dollar amount per unit good consumed. To study the impact of taxation on the market outcomes, let's, for example, take the market for pizza. D1 and S1 are the initial demand and supply curves. In the absence of any government intervention, the equilibrium price of pizzas will be $10, and the equilibrium amount of pizzas being consumed and sold will be 500. Now, apart from the usual definition of demand and supply curves we encountered in Chapter 4, there is another way of looking at these curves. The demand curve can also be considered to represent the highest amount the buyers are willing to pay to consume a certain amount of good. For example, the maximum that the buyers are willing to pay for 500 pizzas is $10 per pizza. Why is that the case? Well, when buyers consume something, they get a utility or a satisfaction from consuming that good. Typically, buyers try to ascribe a dollar amount or a dollar value to that satisfaction. So they are wondering whether paying X dollars for that item is worth it or not. And that's what the demand curve is. In this case, the most that buyers are willing to pay for 500 pizzas is $10. Similarly, the supply curve captures the least amount of money that the sellers are willing to sell something for. For instance, the lowest price that sellers will accept for selling 500 pizzas is $10 per pizza. Why is that the case? When sellers produce output, they have to pay for input, raw material, labor, equipment, etc. So based on these costs, there's a bottom line price which they will accept to sell a particular amount of good. Below that price, they won't cover the costs, so they will not be willing to supply any amount of good voluntarily below their cost price. Thus, the supply curve captures the lowest amount that the sellers are willing to get for supplying a certain amount of a good. Now, armed with this understanding of demand and supply curve, let's first consider the impact of a tax on buyers. So in this case, government imposes a tax of $1.50 per pizza being consumed on the buyers. The way this tax can work is that when buyers go to buy pizza, they have to also drop $1.50 into the tax box at the cash register. So we would expect the buyers to shell out $1.50 more than what they were doing. We would expect them to pay $11.50. Let's see what happens in the market. So now, as I said before, the demand curve captures the maximum amount buyers are willing to pay for a particular unit. When you impose a tax of $1.50, this is an additional expense on the buyers. They value 500 pizzas at $10 a pizza, and this value will not change. So if you want to make them pay $1.50 as tax, you have to charge them $8.50 for pizzas for them to still buy 500 pizzas. So the demand curve will decrease, or it will fall by $1.50, the extent of the tax. Now let's see what happens to the actual price which buyers pay and that sellers get. As a result of this decrease in demand, the new equilibrium quantity now falls to 430 units of pizza. At this price, at this quantity, buyers will pay $11 per pizza and sellers get $9.50 per pizza. The incidence of a tax is the study of how the burden of a tax is shared by the various market participants. In this particular example, buyers are paying $11 after tax, while they were paying $10 before tax. So $1 is the share of buyers on the burden of the tax. On the other hand, sellers were receiving $10 before tax, and they receive $9.50 after tax. So the seller's share in the tax is 50 cents. Now, you may ask, why is the burden being divided by the buyers and sellers in this particular way? Why is it not 75 cents each, or 50 cents and $1, or 25 cents and $1.25? Well, the answer to these questions depends on elasticity, and we will study this in detail in a couple of minutes. Now suppose instead the tax was imposed on sellers. Now the way this tax would be expected to work is, for example, when a buyer comes to a pizza store to buy a pizza, they will be paying $10 to the pizza seller. The seller will, from those $10, set aside $1.50 into the tax box, which is kept at the register. So again, you would expect the seller to pocket $8.50 and $1.50 to go towards the tax box. So now the supply curve captured the lowest price that a seller is willing to accept to supply a given amount of a good. So in our case, the lowest price the sellers were willing to accept to sell 500 pizzas was $10. Now you're asking them to pay a tax of $1.50 to the government. So the lowest price that the sellers will be willing to accept for pizzas and still supply 500 pizzas and also pay the tax should be $11.50. In other words, the supply curve will decrease, or it will go up by $1.50. So the gap between S2 and S1 vertically should be $1.50. Now let's see the result of this tax in the market. And as you can see, the impact is exactly the same as if the tax was on buyers. And before tax, buyers were paying 10. After tax, they pay 11. Before tax, sellers were getting 10. After tax, sellers get $9.50. The burden of the tax on buyers is $1. The burden of the tax on the sellers is 50 cents. So just like in the previous case, both buyers and sellers will be sharing in the burden of this tax. Though in our example, buyers will still share most of the burden of this tax. So the bottom line is that the outcome is the same in both cases. So whether you tax the buyers or you tax the sellers, both will share the burden. And this distribution will be the same in either case. So the key point to drive home here is this. Suppose markets work efficiently. The best outcome would be the free market outcome. 500 pizzas and $10 per pizza. When you impose a tax, buyers are now paying more than what they were paying before. So they will cut back on how much they demand. Sellers are getting less than what they were getting before. As a result, they will cut back on how much they supply. Consequently, the equilibrium quantity of that product will fall in the market. And before tax, what buyers paid was what sellers received. After tax, this is not the case. There is a gap or a wedge between the price that buyers pay and the price that sellers receive. And this gap is same as the amount of tax. Now, let's come to the question of, well, why were buyers paying $1 of that tax and sellers paying 50 cents of that tax? Well, the answer to that question depends on the relative elasticities of demand and supply. Consider soda, for example. We would expect that for a pop, the demand curve would be more inelastic than the supply curve, or the supply curve to be more elastic than the demand curve. Now when you impose a tax in the market for soda, what will happen is that buyers will bear most of the tax. This is because their demand is fairly inelastic. They will not respond much to a change in the price. So sellers can pass the burden of tax on the buyers. So whether government taxes imposes a sales tax on soda, or government imposes a tax on soda manufacturers, the impact will be the same. Because demand curve is more inelastic, it's the buyers who will bear most of the tax. And again, the burden of the tax for buyers is the difference between P sub B and P, the equilibrium price. The burden of the tax on the sellers is the difference between the price before tax and P sub S, the price after tax that they receive. Now consider broccoli. For broccoli, the demand curve would probably be more elastic than the supply curve. Supply for broccoli will be steeper, inelastic. Demand for broccoli will be fairly elastic. If you impose the same tax on broccoli, now it's the sellers who are left with most of the tax. That's because buyers will switch to other vegetables. And the sellers of broccoli, or the producers of broccoli, are the ones who will then have to pay most of this tax. So the lesson we have learned is that if the supply curve is more elastic than the demand curve, then it's the buyers who bear most of the tax. On the other hand, as in this case, if the supply curve is more inelastic than the demand curve, then it's the sellers on whom most of the burden of the tax will fall. So the key point is that whoever side has a more inelastic inelastic curve, whether it's the buyers or sellers, is the one who's left with the tax. Whichever side has a more elastic curve is the one who can escape the tax or pays less of the tax. The bottom line for studying the impact or the incidence of tax is this: if the demand curve is more elastic than the supply curve, this means that the buyers can respond fairly quickly to a change in price than the sellers can. Consequently, buyers will share less in the burden of the tax than the sellers. The burden of the tax will fall more heavily on the sellers. On the other hand, if the supply curve is more elastic or flatter than the demand curve, then the burden of the tax will fall more heavily on the buyers. So, whichever side of the market is more elastic will share less in the burden of the tax. Whichever side of the market is more inelastic will be left to bear most of the tax. So if supply curve is steeper than the demand curve, it's the sellers who foot most of the tax. If the demand curve is steeper than the supply curve, then it's the buyers who share more in that tax. Let's further crystallize these concepts by looking at a case study. So in 1990s, with the desire to raise revenue, Congress adopted um, a policy of taxing the items used by the rich, or the luxury items. This tax was called the luxury tax. The goal of the tax was to raise revenue from the affluent, who could more easily pay the tax. However, which party did really bear most of the tax? Consider yachts, for example. If you're a boat maker, your production capacity is pretty limited to making boats only. You can't really switch to make cars. So the supply curve will be much more inelastic than the demand curve. If you're a buyer, you can buy a yacht, or you can go for a tour of the world, you can buy a luxury vacation, you can do several things with your money. So the demand curve is fairly elastic. Now, based on what we have learned so far, if you impose a tax on yachts in this market, most of the burden will fall on the side which is inelastic. In this case, the sellers. So when this tax was imposed, buyers could easily escape the tax. They just did other things with their money. On the other hand, it's the suppliers of those goods that had to foot most of the tax. What was the result? In 1993, most of this tax was repealed because it had the opposite effect of what was the initial intent of the tax. So here's an example of policymakers imposing a tax which may have gotten them some political capital when it was being passed. But as the forces of market played out, this tax led to the opposite effect. It resulted in unemployment among the workers in those sectors, and thus they were bearing most of the tax, and this tax was repealed.